Welcome to the latest edition of The Bull, the Bear, and You as we take a look at what is happening in the economy and investing. I'm Stacy Smith, and with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Carrie Coghill of Coghill Investment Strategies in Pittsburgh, Frank Rossetti of HF Management Company, Kim Forrest of Boca Capital Partners, and Michael Godwin of Fragasso Advisors, also in Pittsburgh. It is hard to believe, but we've reached the halfway point of the year. And for the first 6 months, all of the major indices have set new all-time highs. And after this first 6-month period, the NASDAQ is up 18%, the S&P 500 is up 14%, and the Dow is up nearly 4%. Now, 2 weeks ago, I asked all of you for your short-term projections of how things might look by the end of the summer. Kim, you alone felt that the bias was to the upside, and Michael and Carrie and Frank were throwing up caution flags based on corporate earnings. Well, the second quarter of corporate earnings season starts now, and it's something that you really love, Kim. So, from your opinion, are corks going to be popping, and we're going to be celebrating the earnings season?
Well, I always celebrate earnings season because it gives you information, and information is a powerful thing in an investor's hands that's willing to buy, sell, or hold. That's the three things that we can do, right? Buy, sell, and hold. And what we're doing during earnings season is trying to figure out what the companies see and what they've done in the last quarter. So not only do we get information about companies competing against each other, but also kind of what the vibe is for earnings season. It's going to be tough this year because we've already got, oh, by the way, happy pre-announcement season, everyone. We are in that time where companies have to correct rather quickly any outlooks that they may have given in the last quarter. And if things are materially different than this quarter, they need to update it. So already we've had a couple of weird ones from a company called Pool. So apparently the backlog of people ordering up indoor or above ground and below ground pools for their homes has been reached, that backlog created by COVID, and people are now spending less. So I think it's an interesting time because this is the very essence of earnings season, like who's a winner and who's a loser and why. Interest rates remain high. Homeowners are not spending. They're not, so housing is tough. So I can't tell you until the end of earnings season what's going to happen. But that's what I wanted to lay out, that it's information time for investors.
Kim,
are you still, go ahead, Carrie, I'm sorry.
I was just sorry to jump in, but that's kind of like, I'm not normally used to hearing you say things that aren't entirely optimistic.
Well,
I was just going to say, are you changing your tune a little bit from a couple of weeks ago?
No, but I think I'm being cautious on sectors. Like I never think all sectors win. They just don't. But I think if they are discretionary and financed by debt, they are likely to lag. Does that push us into a recession? I don't think so. Like that's everybody's question. Is everything going to be okay? I don't know. Nobody really knows. But I think we have this push-pull through the sectors. And that's what is going to be interesting in this quarter.
Well, but if I can throw this out, and anybody else can jump in on it, obviously, but the surge in the markets has been through the tech side, right? And mainly one big company, if I'm not mistaken.
Right. And that's a problem. I'm going to let other people address that because I'm not an NVIDIA believer, like that it conquers all. But it conquers right now.
Yeah, I'll take that real quick then. I mean, you're right, Stacy. NVIDIA for the first 5 months or so of the year, NVIDIA accounted for about 35% of the gain in the S&P 500. And you brought up the indice returns for the year. There's a big difference between the Dow and the NASDAQ and the S&P.
Yeah.
4% versus 15% is a big divergence there in performance. So you had a big driver over the first 6 months, but I think it's kind of nice to see. This is me being optimistic, I guess. NVIDIA over the past 2 weeks has sold off just a little bit, right? But the market overall has been pretty flat over those past couple of weeks, which is a good thing to see. If you see NVIDIA really sell off, but the market can kind of hold in there, all right, some other stocks are doing the heavy lifting there. But again, I think as we move into the back half of the year, you're going to want to be a little bit more cognizant of the sectors you want to hold. I think you're hitting the period where growth is slowing down. I think inflation remains a little bit sticky. I'm not saying it's pure stagflation, but there are sectors and there are types of investments that even work in that type of environment that you kind of really want to, I think, pay attention to a bit more. Tech is one of those sectors that can continue to do well.
What you need to also see is that there's a lot of critical areas of the economy that are slowing down. When you look at I don't know if they were quoting the quarter or the first half, but 5 sectors of the Standard & Poor were up and 6 were down in whatever period they were quoting. And I found that interesting. And we know that what's the car business has some problems. They have a technology problem right now that's going to make sales worse than they might have been. We've got lumber prices coming down because building is slowing down. People are not moving, so they're not going to buy furniture and drapes. And we're in picnic season, so there'll be a lot of hot dogs sold. So this idea of being with sectors makes a lot of sense. And as far as the technology, I'm going to let Kim talk all she wants about that. She knows far more about it than I do.
So I think that Kim and I are like switching places this week because she's a little bit more cautious and I am too, with the exception of technology. I actually love it. And that doesn't mean that prices haven't gotten ahead of themselves, but people don't understand the impact of AI. And it's a game changer almost as much as the internet was a game changer. I'm a true believer in it. It's not that it doesn't come without its challenges, but this is a whole new industry. That's when, you look at demographics, and I can remember 10 years ago, people talking about like, oh, where are the jobs going to come from? And how are people going to get employed? And my response is, 10 years from now, we'll probably have an industry that no one knew existed. And I believe that it's artificial intelligence. I mean, the things that I do with it are like I'm huge about what I eat, right? So I can go in and say, create a meal plan for me that gives me all of my recommended vitamins and minerals for the week. I hit the button and there's a meal plan. Now, I haven't verified it all, but it gives me a start. Like, it's just like, it has the potential to impact.
Okay, let me interrupt just for a second because I'll stay with you for a second here, Carrie. And that is, in the past, I believe you and our other panelists here have basically said you don't jump into a particular stock early on. You want to see whether the returns are coming in correctly, whether the earnings are there, whether the company's going to make money or not. I get the feeling from you right now it's time to jump in on AI somewhere, or am I misreading you?
Well, I think for us, and I can't, for compliance reasons, I can't mention individual names.
Right.
However, it's more about looking at companies that already exist that either are implementing the use of AI, and a lot of these consulting firms are going to be booming because every business is saying, how can I become more efficient and productive? Mature businesses. There are also very mature technology companies that benefit from this. So I am not, I don't want to go back, and I think there's risk to going back to the internet bubble where you had companies that didn't make money, didn't know how to make money, that were new, and their prices shot up. So you have to still be very wary of that. But there are some very, very mature companies that will benefit from AI.
Okay. Go ahead, Mike. Frank.
Many companies will employ AI to make themselves more efficient. And that transcends all of industry, I believe. The question I have is which companies that are actually, quote, doing AI are going to make a profit. Carrie brought up one interesting thing that I hadn't thought about, which is the consultants that will help the corporate America employ this stuff, because of course the baby boomers that run the companies are not necessarily that well attuned to technology, and they'll need help.
Okay, we need to wrap it up there. We'll take a break. We'll be back in just a moment. Welcome back, Michael. What should an investor do? What kind of advice do you give, I should ask, when a company does not meet earnings expectations? Should you consider selling that company and move on to something else?
That's a better question for Kim, but I'll take a stab at it and let her jump in. Again, I hate saying this, but it depends on the company because that's such a wishy-washy answer. In general, I do think if a company misses, and let's take the tech sector out of it, because companies can miss in the tech sector and magically next quarter they crush it and it's good. But when a consumer discretionary stock misses, a lot of that price movement is baked in almost immediately, 80 to 85%. We saw it on Friday. This is not a recommendation nor a sell argument on Nike. Nike sold off 20% on Friday, and that was the worst day it's had since 2001. So at a 20% downward move, 80 to 85% is baked into it. What I do think happens, though, Stacy, is it's very hard for a company to do something in that space to shoot back up 15, 10% or so. My guess is the momentum in that stock is probably to the downside a little bit. They have a lot of managerial issues there that you need to look into. And that kind of goes across the board. If you miss on earnings or revenue, you're going to have some sort of problem, potentially in the managerial side of things there. But again, 80 to 85, 90% of it's already baked in on that price movement right after the earnings come out. And then generally the momentum kind of can continue to carry it lower. But
help me here. What do you mean by the 80 to 85% of it's already baked in?
Well, priced in, you had a 20% downward movement when the earnings came out. 20% the stock sold off immediately because of that earnings. That was the surprise. So they surprised the downside. So it's not as if you buy it now or sell it now, you're going to either recoup any of your losses or gain to the upside there. It's all kind of already happened. But the momentum on that stock is not really looking good. So, or on any stock that misses that much.
Right.
So I don't say you sell, but I think a lot of it's already been priced into the stock.
Does it make a difference whether the entire sector is on the decline or on the upswing? Let's say you have a dichotomy where you have the sectors moving up nicely, as you pointed out that this happens with tech a lot, and you might have one tech company that doesn't do well, but then for tech companies, they just figure out how to move up higher, it seems like. But anyway, is there a dichotomy that plays in your decisions?
Well, yeah. I mean, I think if I'm more of the macro side of things, so I believe I like the sector outlook and the factor outlook. If you have a sector or a factor that's doing very well and a stock in there is not, that would raise a couple of big red flags on my viewpoint for sure. And then obviously vice versa. If the sector's not doing well, but one company's doing great, that should pique your interest in doing a deeper dive on that name.
Right. And I mean, we can even contrast what has happened to Under Armour. Like, we're going to talk about Nike. And again, nobody's saying buy this, sell this, whatever. We're just using this as, the classroom example here. And Under Armour was hot, right? Like, it was white hot. Every kid wanted it. The management was kind of new at being a big company. That's always kind of a scary thing. So you'd have to watch that as they grew. And then somehow they just sent too much product out in the channel and diluted their brand. And now I think the stock, the last time I looked at it, it was around $5, right? And it had been up at 60 at some point. And as Michael said, once the bloom is off of that rose, and it was really kids wanting to own their product at any price that nagged their parents until they got it, right? And when that falls off, that's the driver for the stock. And you have to pay attention to that. And we're just using these consumer companies because it's pretty clear that, there's one driver for the company. And once that dries up, it can be dead money for a very long time. Now, as Michael said, Nike has some management problems. They're going to reshuffle the deck. They do have a very long history, and we'll see if they can come back from this. but, and they have, they're all around the world. But you just have to look at it kind of as a study in a business. What's going on with the business? How long is it going to take to fix? And should I keep my money there or not? Those are the questions you need to ask.
Yeah, because what we often say in our industry, and people really don't like the answer, but a lot of times when the market sells off, you'll hear us say it's a buying opportunity. And so when a stock misses earnings, you really have to then call Kim and say, tell me about this company. Is it a buying opportunity? And there are a lot of factors, what's going on with their margins, what's going on with their debt. It's one of the things we're going to be really paying attention to this earnings season is, with interest rates up, how much of an impact is that having on these companies that have revolving debt, or they have maturities coming up and they need to refinance at higher rates? What impact is that having on their margins? Or if their margins and debt have gone to the negative, did they buy another company? Like, there's so much that you need to look into before you make a decision. And the other real headwind to all of this is that stocks usually react, 6 to 9 months before any of us have any idea that, unless you're doing your homework, the average investor, retail investor, isn't going to be able to get that far ahead of the curve to be able to make decisions before something tops or something bottoms.
It's time for me to tell a story. Years and years ago, I had inside information. I didn't use it because, of course, it's illegal. But it was interesting that when the news came out, it was bad news about a major company. And I figured the stock would go down. And the day it came out, the stock went up. And the reason is I came to the realization was the market had figured out what was going on long before the management who leaked this information. So the buy on the rumor, sell on the news, or sell on the rumor, buy on the news in this case might have been apropos, but that would have been using inside information, which you can't do.
All right. We need to take a break. We'll be back in just a moment. Welcome back. The last time we met, we had a great discussion on stock buybacks and stock splits. Let's delve a little bit more into the stock buybacks. The four of you had some different opinions about this. Michael, you said it could be a good way for corporations to give back to their shareholders. Kim sort of disagreed, saying that she would rather see the company invest in itself to use the money to grow. Frank, you stated that your concern is about the buybacks contributing to a shrinking capital market. And Carrie, you raised the question as to whether buybacks can be a negative and whether some investors would do better with an increase in their dividends. So we ended the discussion with you, Carrie, saying that it comes back to risk tolerance for the investor. So now I give you the floor to continue that thought.
Well, I think the biggest concern I have about buybacks, and this really piggybacks on what we were just talking about with retail investors, is that if you see that earnings have gone up, what's the reason for that? Is the reason earnings have gone up because the company bought back its stock, which is a kind of one and done or over a period of time? Or did earnings go up because they actually improved profit margins or sold more goods or services? So I think that it can be misleading. I agree with Kim that the shareholder really should benefit. And this short term, let's prop up earnings just for the sake of it, that's not a long-term solution. So you can benefit your shareholders by reinvesting into the company and making it even better, or giving it back to shareholders in the form of a dividend. And that's really where the discussion about risk tolerance comes in. Because someone that has more risk tolerance is probably more interested in companies that reinvest into themselves to grow faster and better versus maybe someone who's approaching retirement or in retirement that really wants more steady, consistent growth and an income stream along the way. So looking at what stocks you own and what those companies are doing with their excess earnings is really important in order to decide what's the best stock for you.
Anybody want to add anything to that?
No, I think that's a perfect wrap up here, because there's only so many ways a company can act with its money, with its resources. And, you have to interact and decide what you can tolerate. And, some companies that don't have great prospects for growth spend on their projects anyhow, and they don't go anywhere. So, again, we're back to looking at the fundamentals of a company, saying, does this excess cash merit going to new projects? If you don't really have any good new projects lined up, so that's even more than risk tolerance. But that's where you have to begin: is what kind of investing can you tolerate, and do the companies I own facilitate that, and are they good at what they do? That's the final thing.
Are there certain companies that are more inclined to buy back their stock than others?
Yeah, companies that have tremendous cash flow and nowhere to put it. Apple, I'm talking to you. They've done a really great job over the past 10 years of shrinking the size of the outstanding shares, and by using their cash that way. And I guess it's fair, as opposed to, they've done a fair amount of reinvesting in themselves too. So they just had gobs and gobs of cash. And I guess Microsoft belongs in that as well.
Tech seems to buy back their shares a little bit because they also issue a ton of stock to their employees. So they try to not dilute the overall shareholder value a ton. So they'll buy back some of the stock and they'll issue some stock to their employees. The other thing I'd point out is anytime you get a dividend, that's taxed as ordinary income. So that might be higher than if you get a buyback and want to sell and you get tax the capital gains, which are generally 20%. You got to take that into consideration as well. It's one of the reasons why I like buybacks, probably a little bit more than dividends in that regard. And then, shoot, I did this a couple weeks ago. I had another point, Stacey, I wanted to mention. Again, Governor Rick Perry, again.
I think we've all been there.
Yeah.
I think we've all been there.
I hate to tell you, it's going to get worse.
Well, is it? I mean, it better not be like we saw at the presidential debate a week ago or so. I hope I don't get to that point. Again, I don't want to get off the train too far here.
For the audience's sake, I have to correct something you said, Mike. I don't mean to do this to you, but dividends are not taxed at ordinary income rates. They're taxed at 10, 15, or 20%, depending on.
You're right. I had bond income on the brain there. Sorry.
Nothing worse than
mistakes.
Nothing worse than bond on the brain.
Yeah, there's nothing worse than bonds on the brain.
All right, we need to take a break. We'll be back in just a moment. Welcome back. Well, Frank, let's talk for a few minutes about IRAs. There are several different types, a lot of different types, but let's focus on the two basic ones that we hear about a lot, the traditional IRA and the Roth IRA. Is one better than another for an investor?
It's no. Generally speaking, no. If you're in a low income tax bracket, the Roth IRA is better for you. If you're in a high income tax bracket, the traditional may be better for you. If you have a lot of qualified money, which is what IRAs, pension plans, and 401ks are, you might have to do a little future tax planning to avoid being in a high tax bracket forever. If you really have accumulated a lot of money, you're probably going to be in a high tax bracket no matter what you do, in which case the traditional still makes sense because at least you're working with Uncle Sam's money until you take it out and then pay the big taxes. But I used to tend to try to saw people off contributing to these things once it got to a large amount, because to me, it was mandated, it was dictating that they would have to be in high tax brackets going forward. And if they were in the in this day and age in the 24% bracket, and they start accumulating millions in their pension plans of IRAs and whatever, they might be in the 30% bracket or 32. I can't even remember what the next bracket is, 33%, whatever it is, just because they have all this money accumulated that they have to start taking out when they're nowadays 72.
Yeah,
And
it's a
it's all about thinking ahead and where you're going.
I mean, Stacey, this is why those of us that work with clients are in business, because it really is a puzzle, especially for high income earners, because you would think sock away as much money as you possibly can.
That's what you're preached to. That's what's the preach.
Right, right. And generally that works out, but it doesn't come without some planning. To Frank's point, what if now I'm pushing myself, if all of my money or the majority of it is in tax deferred investments that I have to start taking in my 70s, what does my tax bracket look like now in my 70s? And do we think tax rates will be higher or lower? The way that our deficit is growing, I'm not sure they're going to be lower. So you really have to understand all of these different types of deferred plans, whether it's a Roth or, in your 401k. Most people have a traditional option and a Roth option. So how much should you put in each? And that's really where doing some retirement planning makes a lot of sense, so that you can figure out the best combination, not only of tax deferred and tax free, but also what about individual money? What about money outside? We know we have a lot of people that are retirement plan poor because they've socked all of their excess money into tax deferred and ultimately tax free vehicles. So there's a lot to consider.
What happens when that person needs a car is they have to take an additional distribution out of their IRA, which means instead of taking out the 40, 50, whatever the car costs, they got to take out 60 or 70,000 because they have to pay tax too. So it needs to be thought about. So the Roth, on the other hand, you don't deduct it going in, and you don't pay tax on it when it comes out under current law.
Right. You pay a tax on what you invest in the Roth.
Correct. You don't deduct it going in. So you're putting after tax dollars in, but you're taking tax-free money out in the end. On a traditional, you deduct it going in, but when it comes out, it's ordinary income.
Well, then I guess you didn't play the game that Carrie just brought up, and that is, if you think tax rates are going to go up, a Roth makes a little bit more sense right now. But then again, you just don't know.
In that scenario, Stacey, you're also likely going to be making less income at that point in your life too. So you're trying to play that tax bracket game as well. This is one of the instances where, even with the financial textbooks kind of tell you to do one thing, my personal belief, I'm on Carrie's belief. I cannot imagine that tax rates, ordinary tax rates, will be lower in the future than they are now. I'd almost rather take the pain, even if it doesn't make sense for me in a personal standpoint of putting it into a Roth 401k, Roth IRAs. I'd rather take the tax hit now and then not have to really deal with it.
Well,
20 years.
That's really a function of what tax bracket you're in today. If you're in the 37% bracket, that probably is not the right thing to do. If you're in the 22% bracket, which for a married person, I think is up around $170,000 of taxable income, if I remember correctly. Google it. They'll gladly tell you what that bracket number is. It might make sense not to deduct the money because you're probably never, if you're a saver, you're probably never going to be under the 22% bracket.
That's one of those things, Frank, where you're right. I mean, from a textbook standpoint, it doesn't make sense and I'm not in the highest tax bracket. I'm not close. But even if I were, I'd still might bite the bullet and do it now. I have clients who just don't want to have debt on their balance sheet at all, and so they're working hard to pay off their mortgage at 3%. And and I get it. Like, I mean, I don't get it, but they really don't want that on their balance sheet, and they want to pay it off. So good for them. I don't want to have to pay taxes to the government when I'm retired, so I'm going to do whatever I can to just continue to sock away money into my Roth now and just bite the bullet more now, even though if it might not make sense from a textbook standpoint.
This is where I disagree with you a little bit, Michael. You said you don't want to pay taxes down the road. I don't want to pay them right now if I can get away with it.
Right?
Well, the one thing I want to add here, and I think it's really important, is that the people that really should be taking advantage of Roth accounts are young people. When they get their first job, like, put money away before you get married and have kids and you have no extra money. There have been projections done showing people that contribute from age 18 to 26 and stop, comparing it to someone that waits until they're 26 and contributes until they're 65. And that person that contributed early on and stopped actually ends up with more money.
Wow.
You know, there's a lot of factors in that, but it really, really is like, they don't want to think about their retirement. This is where,
Yep.
you know, parents and other people, programs like us, like, just do it. You can always stop it, but just do it.
Yeah. Kim, you want to wrap it up for us?
I do. I want to tell you, I think this is not an urban myth that Peter Thiel worked at, I think it was PayPal maybe, and put his shares into the Roth IRA. So he was making like enough money that he could put something in there. He puts these in and he has literally billions of tax-free dollars
By using the Roth.
And
by
that's
using the Roth IRA. So
that's the
he
sort of
was
thing
a
a
smart.
politician's going to look at and try to change that law.
Well, that's just, I want to end it right here. And that's what I was just going to say, by the way, is that we can talk about this all we want, but we don't know what they're going to do with tax rates or make changes to IRAs down the road. I mean, if I'm not mistaken, the IRS tweaks the IRAs, especially like inherited kind, every once in a while, so that you don't always come out like you think you're going to come out. Anyway, we're out of time. Guys, thank you so much once again. It was great to have this conversation with you, to Frank and Michael and Carrie and Kim. And we hope to see you again the next time for The Bull, the Bear, and You.